The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back to another episode, the Apartment Gurus podcast. And we have a really cool, highly visible, highly impactful thought leader on the show today as a guest. Justin Goodin is zooming in from Indianapolis, a couple hours from my hometown of Cincinnati, and our target market of Columbus, Ohio, is just east on I-70 from where Justin's hanging out in the world. So, and for listeners, if you have the ability right now as you're listening, check out Justin on social media. In particular, Justin Goodin is Goodin, and connect with him if you can right now. But check out the level of content that he provides, the level of value that he provides, really consistently a lot. He's a great follow on social media, and is always asking big, important questions and starting really interesting conversations in the multifamily investing space. So, that's how Justin and I have connected having probably the last year or so, I'd say. And Justin's got a great story with, having been partnered with and working with some big forces in the industry. So, Justin, welcome to the show, man. Super glad to have you.
Yeah, likewise. Thanks for having me, Tate.
Yeah, you bet. So just if you could just kind of give us a little, a little backstory on you, Justin, and especially as it relates to your professional journey, your entrepreneurial path. To me, that's almost like a hero's journey, if you will, in the kind of in the mythological space. But I love hearing the entrepreneurial kind of progression in people's lives. And that, of course, as it relates to your real estate path and journey in terms of getting into commercial and whatnot, and kind of take us to what you're doing today.
Yeah, happy to dive into my story. But thanks for having me again. I'm here in Indianapolis, Indiana. I got my first taste of real estate when I was going through college. And, we hear all these awesome things about real estate, passive income, cash flow. And like most new investors, when I thought of investing in real estate, I was like, okay, well, I'll go buy a fix and flip or a single family rental, which is exactly what I did. Mm-hmm. And that's a really key distinction. I think that, we are trained to start small. We're trained to be conservative. So, like most people, when I got the idea of getting started in real estate, my first inclination was to go start small, get a single family rental. So I did just that. I bought a single family rental on the west side of Indianapolis. And this was back when houses cost $44,000, if you can believe that. And this was a recently renovated house for $44,000. Wow. So yeah, you can't find that anymore. But anyways,
what do you think something like that is worth today, just as a reference point?
Yeah, well, I actually sold it just about a year and a half ago for double the price that I paid for that. So that appreciation over those, 3-4 years really kind of adds up.
And
yeah, that was my
that's
first
still an
taste of.
incredibly affordable asset, you know.
It is, yeah, it is,
Yeah, for
and
sure.
great area of Indianapolis as well.
Right. Nice. Okay.
So, I mean, that was my first taste of a real estate. Quickly found out that that was not passive. It didn't provide that much cash flow and all those great things we hear about real estate. It was really kind of just like another job on top of the job I already had, which at the time was, working and also going to school. So I started doing the single family space like through business school. I studied finance and supply chain management at a local business school here in Indianapolis, and sort of like going through my business school on senior year, I got really intrigued by apartment investing, commercial real estate, and just knew I wanted to do that, after graduation.
Let me interrupt you right there, because there's something pretty significant there that I'd love to get a little closer look into. So, you made a couple really good points. So many of us started with a single family deal, right?
Yes.
I certainly did. Actually, mine was a duplex, but even that was like, it was essentially, I was looking for single family deals, and I just happened to find a duplex, and then did a lot of other single families, kind of one at a time, fix and flip, same sort of thing. And I love what you said about we're kind of trained to start small, right? And that's like almost a whole conversation waiting to happen in terms of mindset, the way that we are wired to not take risks, like our fight or flight kind of wiring, and our primitive part of our brain does not like taking big risks, and it doesn't like trying to stretch and get its head around something big that would involve like significant change, right? Which getting into like larger scale commercial real estate, and in your case apartments, in my case apartments as well, that's a big shift, man. So you were in business school, it sounded like you were working as well, and you were working the real estate, and then you just kind of like all of a sudden it sounded like you decided you wanted to do the apartment thing.
Correct.
Was there? How did you even get your head around that? Number one was like even an option, because it took me forever, right? And then number two, like, how did you get your head around like that you could do it?
Yeah, awesome question. So in my case, it was really difficult to scale. So, for most single family real estate, you're putting down 20%, 25%. So for me to like scale my business, my portfolio, I'm having to put down 20% for every property I buy. And fix and flips, I mean, you may be able to put down, less than that, but it's not passive. It's just more of a part-time job. And nothing against single family, fix and flips, things like that. I mean, there's people out there making a killing doing that. I just knew that I wanted to scale. I wanted to go larger, quicker. I wanted those benefits of what apartments have to offer. So for me, that's kind of like why I made that switch. And then mentally, I just started doing a lot of self-education, reading books, listening to podcasts just like this, just doing a ton of self-education, just around the clock, and educating myself about the process, about raising money from investors, partnering with other local individuals, and how just studying like how people are buying these larger scale apartments.
Gotcha. And what year was this roughly?
This was 2018, 2019.
Yeah, that's okay. Awesome. We did our first couple small, like 12 unit or 20 unit in kind of that time frame, and so we were starting to kind of catch the vision ourselves. Did you have somebody in your space that was already doing it? Or did you hear about people doing it on a podcast, or, how did you catch the vision? I guess what I'm getting to.
Yeah, absolutely. Nobody in my space. Parents were not entrepreneurs or real estate investors. I really had to go out and build that network myself through, LinkedIn, Facebook. Local meetups was huge. I started attending a local multifamily meetup. So just kind of, started from scratch and just started immersing myself like in this different environment.
Yeah, just huge valuable takeaway there for listeners. Hopefully you guys are, it's kind of an obvious one, right? But like immersion in any and all thought leadership and networking opportunities that you have is just like key. It's so key, especially when you're number one, developing your own vision for what you want to do and what's possible to do. The more options you have around you, the more people that you have around you that can get things done or help you get things done, the more options you have, the bigger you can think, the bigger your vision can get. And so, but also just kind of, I think, gaining some confidence in the sense of like learning the business, right? Learning the language, learning the conceptual stuff, and getting to swim in that space intellectually and otherwise, whether or not you're doing a deal necessarily right out of the gate or not. Right. So yeah, I think that's I love how that was a big part of your kind of transformation and evolution into this new chapter of your path, man. That's really cool.
Yeah, exactly. Thank you.
Yeah. So, okay. So 18, 19, you catch the vision, you start putting into place your network, your specialized knowledge. Where did you start building what'd you do at that point in terms of, your own brand? Did you join another team? What happened there?
Yeah. So next step for me is when I really kind of, started getting intrigued by commercial real estate. This was, right when I was graduating college. So after graduation, I took my first job as a multifamily underwriter for a commercial bridge lender.
Mm-hmm.
So did that for, a number of years, kind of seeing how banks underwrite deals, how they evaluate sponsors, all of which was, fantastic experience for myself and kind of help, build like a really good foundation that, kind of translates into what I do now. Mm-hmm. So, just kind of seeing that perspective of, from the banking perspective and now being on the investor standpoint, I think I have a unique perspective that I've, been on both sides, but was a commercial multifamily underwriter for a number of years and left that job to pursue real estate full time. As about 3 years now, I've been in real estate syndications full time.
Yeah, gotcha. Yeah, I mean, again, like you said, what a fantastic foundational experience and set of experiences, and probably at this point skill sets and like.
Yeah, exactly.
Industry knowledge, like gained from that job you had, the underwriting job. It seems to me like you would, like you said, especially doing what you do now, because you're basically, you're looking in depth at deals. You're also looking in depth at sponsorship teams and working the industry from that angle of things. You probably learned really, really well how to like run due diligence and on every aspect of all of that, right? I would think.
That's right. Yeah, I would agree with that.
Yeah. Some of the questions to ask that others might not. Yeah.
Correct. Cool. Yeah.
Yeah. Awesome. Okay. So last 3 years, man, kind of paint the picture of what you've been doing the last 3 years as a syndicator.
Yeah. So we invest, primarily here in Indianapolis, Indiana. So where I'm located now is where we're investing in and surrounding nearby markets. Mm-hmm. But I founded Next Level Equity, and we're a company dedicated to buying, cash flowing real estate here in Indiana and nearby markets. We look for A and B class value add opportunities. Everything we buy is, stable, cash flowing day one, but just may need a little bit of a TLC, fixing up properties, renovating the inside and out, and usually selling after, 4, 5, or 6 years. So, really bullish on the kind of the value add business strategy. And we've done everything from joint ventures, real estate syndications, and raising money from investors, done seller finance deals, large and small assets, a little bit of a variety of everything.
Yeah. Got it. Super exciting. So so listeners, Next Level Financing, Next Level Equity, rather. I was on your other page. Right. Nextlevelequity.com is where you want to go to kind of see everything that Justin just described in the form of a landing page here, and kind of see their profile and what they do for, particularly passive investors. This is a great site for LP type investors that are looking to get their feet on the ground with an experienced syndicator that, how many deals do you think you've underwritten, Justin, in the last 4 years, 5 years?
Too many to count.
Yeah. I mean, like
probably hundreds of deals.
Yeah, I would think. I mean, way more as it, from coming from the job you had into the role you play now. I would think you would just have an incredible eye for what and also a very distinct buy box. And you kind of went through your buy box in terms of criteria that you're looking for in the way of markets. You mentioned cash flow on day one. Stabilized asset. And you and I think have a lot of alignment there. We're in, essentially our markets are right next door to each other. And I think you have my impression is that you're not disinterested in Columbus, right? And I'm certainly not disinterested in Indianapolis. Right.
Let's
put it that way. And Cincinnati too. I think these oncoming, whenever it starts the next positive economic cycle, and it, again, who knows when, where, et cetera, but the next upcycle that's consistent, I think, is going to serve the Indianapolises and Cincinnati's of the world so well because of where they're positioned now in terms of affordability. I read an analysis that pointed out that really that kind of middle Midwest area, it's really like the last real solid area of affordability left in the country,
Wow. Okay.
So if you think about
the Midwest in general, and, especially Indianapolis, Columbus, places like that, I mean, they're very, very affordable places to live. They're very business friendly, very landlord friendly. And, speaking just for Indianapolis, but I mean, as of now we're in, late 2023, Indianapolis is still actually achieving rent growth. We're still at around 3-4% right now.
Right.
While, a lot of other markets around the country, the Miami, the Dallas, the Austins of the country, I mean,
Phoenix.
while those are, Phoenix, while those are fantastic markets and will continue to grow long term, in my opinion, have been, a little bit inflated the last couple of years, and are now experiencing either, flat or negative rent growth in some cases.
For sure.
So, I always tell investors and other partners that Indianapolis doesn't boom like an Austin market,
right.
But the places, like Columbus, Indianapolis, they also don't bust or go into like serious downturns like
right.
some of these other markets that may be inflated. So very, very stable, very consistent, as you know.
Right. Yeah. And, a few other kind of just obvious, like right now, one of the kind of obviously interest rates are the big elephant in the room. And that's really changing and, in some cases hurting our interest in our industry. But, insurance is that's a real problem in certain parts of the country right now. And we're seeing increases in Columbus for sure. And I'm sure you're seeing them in India as well, but nothing like what you're seeing in Florida or, really anywhere in the Sun Belt, even in Oklahoma City where we are, where there's, Tornado Alley kind of thing. It's, Ohio and Indiana are just pretty tame, relatively speaking, in terms of weather and insurance rates.
Yeah, so, absolutely. Yeah, definitely seeing some increases, insurance, taxes, of course. I mean, like any market in the country right now, but, compared to some markets, it's, a lot more affordable when you look at compared to other markets.
Yeah, for sure. Yeah, because you're starting at such a low base to begin with, in
correct.
These cases. So, just kind of rounding out your buy box, a few other kind of curiosities, I guess. Do you have, you have specificity around vintage in terms of assets?
Yeah, primarily moving forward, we're buying anything, 1985 or newer.
85.
Really bullish on kind of like the A and B class area. Yeah. In my opinion, they just have less maintenance issues. You have better quality tenants, less, bad debt issues. Mm-hmm. So in my opinion, it just makes a little bit more sense to buy newer in fantastic areas. So, obviously I invest here in Indianapolis in my own backyard.
Yeah.
The main benefit of doing that when you're investing in your own backyard is, the areas of town to invest in and not to invest in. Right. Sure. So, the
sure.
deal is important, buying a little bit newer A and B class product, but also just the specific neighborhood and area of town it's in. I think that is just as important, if not more.
Yeah, 100%. I mean, location. And then in our business, crime is like a huge thing. It just,
Yes.
I don't know. I actually remember a post that I think you did somewhat recently about kind of would you buy in, or something about owning in a high crime area, right? Like, is there, and for us, it's just a complete no-go. Like we've looked at stuff that we actually loved, like, great townhome layouts, nice vintage, and we're all excited about it. And then we see, just a completely deal-breaking crime report, and we're just out. Like, we're just done with that deal at that point. Kind of no number makes sense in some cases.
Right. Yeah, I would agree with that. Yeah. Depending on, the crime, the area, it's, really kind of like a no-go. I guess, depends on your, risk profile, but it sounds like we're pretty similar, and that's kind of just a no-go. So not enough upside for us.
Yeah. Let me kind of go a little different place here with you, Justin, because you are a kind of almost a concierge, if you will, in that sort of role for LP investors into this business, into this asset class, and so your level of understanding of the industry, of the market, of market trends, large scale, and then of course your ability to understand a specific deal and a specific asset and a specific submarket is incredibly valuable. All that stuff is necessary, I think, to provide as much value as you provide. So being actively every day in the space of communicating with retail level investors, given where we are in this economy, what's your conversation like? What themes are you kind of hitting on? What concerns are you hearing from investors at this point? Pain points, motivations, all that stuff. Love to get your perspective on that.
Yeah, so what I'm hearing is just investors are still optimistic about the future of multifamily real estate in general. There's hesitation just with interest rates, the uncertainty in the market. But I think most investors, and even like the even more sophisticated investors, they seem to be bullish on multifamily long term. They still understand the benefits of multifamily long term. My personal belief that this is one of the best times to buy real estate right now. Real estate is always going to go through market cycles.
Yep.
I don't think this one is any different. Long term, I'm still really bullish on multifamily, and at least to the investors that I'm talking to, they have some hesitation and some concerns. I think just after seeing the headlines and the mainstream news, which is understandable, but from what I see, I mean, they're still bullish on multifamily long term, and they're still optimistic.
Okay. Yeah, I love what you kind of hit on 30 seconds, 45 seconds ago, in terms of like almost like now more than ever is like a great time to be considering, diversifying into this asset class. And kind of here's why, right? Like and then, my messaging is along the lines of like the hedge against inflation conversation, right? Like, there's no guarantees in that, but the general concept is that as inflation goes up, rents go up with inflation, and therefore the net operating income of the property theoretically goes up. There's obviously going to be expense inflation, so you got to figure that in, and you also have to figure in potential cap rate decompression into that conversation. So it's not a simple conversation. You don't want to oversimplify it. I don't think, but there is the undeniable reality of at the very least the potential of your top line kind of hedging or going with at the same rate of inflation, right? And in some cases, like you said, Indy's got actually continued market like rent growth right now. Some markets are are freaky markets that just keep, they're so good on a micro level that they keep going up. So, the hedge against inflation conversation, the recession, either recession resilience or recession resistance, obviously, you certainly not any guarantees there. And you need to, I think, especially qualify that statement, those discussions for sure. But I think 100%. That's another one worth pointing out. Risk mitigation to a certain degree, right? Like you especially in your case, you're buying assets that are stabilized, that maybe have a small value add or, a modest value add component, but cash flow day one, like that's pretty risk mitigated business that you're buying right there. So,
absolutely. Yeah. And Tate, off of what you just said, but no matter what is going on in the market, in the economy, what happens on the news, people are always going to need a place to live, no matter what happens. Yeah. So anything could happen, but I just know at the end of the day, people are still going to need a place to live. And that's why the location is so critical and important in real estate. But that building is a tangible asset, is going to be there. And at the end of the day, people need a place to live. And it's pretty known that there's still an extreme demand for housing. Yeah. The rising cost of houses is getting more and more expensive every year, which I believe is going to, force and incentivize more people to rent. So, I mean, if you're bullish on those, few fundamentals right there, then, it kind of just speaks to the strength of multifamily.
100%, man. Yeah. That's a great point about the cost of single family housing, and especially with interest rates now where they are, right? Like the affordability is like at a multi-decade low right now. And most of the country, a lot of the country, certainly where I am in Utah, it's, we've got the factor of, money coming in from the coast, people selling $2-3 million homes in California and coming here and buying something for, $800, that's 3 times the size, and driving pricing up, micro things, right? Like, but overall, especially when, again, like to take Indianapolis it's just a great, solid, very economically diversified market. Middle America, right, at the crossroads of a number of like key trade routes and interstates, et cetera. Very, within a day drive of the East Coast ports, that's a big thing with logistics. So like, again, like just a solid employment base that's not going to get shocked by, let's say a quote unquote normal sort of recession or downturn. Great. So cool, man. So, again, on the LP side, do you go into kind of like, do you go into the discussion about the stock market at all, and kind of highlight the pain points of being in the stock market? Is that part of your conversation?
Yeah, it's funny you mentioned that. I actually just had a conversation today with a potential investor about kind of like the, pros and cons of real estate versus stocks. And, this investor was telling me that he's had a mutual fund going for, over 5 years, and he's had little to no difference in the value in the past, 5 years. Like, it has not changed. And, nothing is guaranteed in real estate, but, I'm sure you're very similar as well. But, in these real estate syndications, we're looking at deals that offer the potential to double investors' equity in that whole period. So whether it's, 4, 5, 6 years, we look for equity multiples around that 2x mark. So, to have money invested for 5, 6 years and have it be the same value while your fund manager is still taking fees, there's just got to be better options out there.
Right. Yeah. And it's great. I mean, you spoke about it really well, really quickly, and like pointed to a number of like things that just kind of suck about being in the stock market. And then you throw volatility in, right? Like, you're Correct. In a mutual fund or whatever, like the possibility to lose a significant chunk of that value in a single event sort of drop or, whatever is very real. And Correct. and, obviously mutual funds are invested in companies that provide value and products and services and that sort of thing. So it's not like that's a valueless asset, but I love in our space how you can basically take an investor to the asset, right? And walk around it and like talk about the value that it's providing residents and what a great life we're helping them achieve. And at the same time, doing right by our investors and helping them grow their wealth and their cash flow basis and everything else. It's just such a cool thing. And you throw in the tax advantages, potential tax advantage, all that conversation and the cash flow, monthly cash flow. In most cases, a lot of cases, syndicators pay a preferred return to LP investors. You do that, I believe, don't you, Justin?
We do.
Yeah. So we always model that too. And we're very similar. Like we're looking for about a 5-year model and about a 2x equity multiple. So, even in this market, like it's obviously not crystal ball clear right now how things will be, but that's, conservative assumptions. That's what we're shooting for.
Yeah. Likewise.
Nice. So like, what's kind of next for you, man? Like, you've got your site, you've got your underwriting service, which we haven't even talked about, but that sounds kind of next level for sure. No pun intended. But I guess kind of bigger picture, like what do you see? Where do you see? Let's just talk next level equity for a second. Where do you see things going with next level equity?
Yeah, we're going to continue growing here in Indiana and nearby markets. We are really bullish on ground up development, and we're working on our first ground up development deal coming soon, hopefully this December or January 2024. So yeah, we're going to continue growing here in Indiana and just looking for awesome cash flowing assets and working with investors and helping them achieve financial freedom. Yeah,
cool. So ground up is that Indy?
It will be.
Yeah. Like apartments. What's that looking like?
Yeah, it's going to be a mixed use apartment complex. So it'll have 76 residential units.
Nice.
It'll have 2 office components and 2 retail components too as well.
Cool. Yeah. And that seems to be in general, like what the cities seem to have a lot of appetite for right now. And the multifamily projects you see getting approved and a lot of these cities that are growing and building right now. And there are some that are, you see a lot of mixed use cities really like that concept right now.
Exactly. Yeah. It's bringing jobs, it's bringing people to the area. So absolutely. You're spot on.
Yeah. Cool, man. Okay. So I guess I put you on the spot a little bit. I think you can handle this though, Justin, knowing you a little bit. So, it's kind of circling back up to, kind of this whole idea of starting small, right? Like kind of how we're kind of in one sense we're wired, I think, to not take risks sometimes. And as entrepreneurs, of course, like we're wired a little differently, I think, in a lot of cases, like, and maybe there's a different sort of programming to a certain degree in born entrepreneurs. And I'm a lot like you, dude. My parents were not entrepreneurial and not real estate investors. And I didn't have real estate on my horizon at all until I was probably 28, 20. Yeah. Let's see. I was 06. So no, it was like, I was older than that. I was like early 30s. And I had owning businesses and being my own boss on my radar. But as far as even real estate in general, like not to mention commercial, scaled up, that sort of investing. And so like going back to, say if you could go back and kind of like coach the guy in college, right? That started with that one single family project in West Indy at $44,000. I think what he said. Yeah. Kind of, I guess, how would you coach that guy at this point, knowing what you know now?
Yeah, I would have told him to like go straight into multifamily, whether that's a 6 unit, a 20 unit, or a 50 unit starting out. I mean, just not being scared to go bigger, faster. I think a lot of that just comes from, like the mindset shift, like we talked about.
Yeah.
But, to me, I mean, that's going to be the biggest ROI is just, studying people who are where you want to be in 10, 15 years and just creating a step-by-step action plan of how to get there. So doing a lot of self-education, taking people out to lunch, coffee, networking at meetups. I mean, like we mentioned, but just doing things to like immerse yourself into that environment.
Yeah.
So that's what I would coach that younger guy.
That's great stuff, man. What are your thoughts on like, paid masterminds, paid coaching programs, stuff like that?
Yeah, they can be good. They can be good.
Yeah.
There's a lot of them out there nowadays. So definitely be careful about which one you're choosing. But, mentors are great to, go bigger, faster, whether that's, mindset, business, what have you. But yeah, mentors can be good.
Yeah. I think I see them as, like you said, you got to, do your diligence and go get the right one, big picture, and also the right one for you. I think kind of on almost a personality level to a certain degree, and somebody that excites you and like makes you fired up to go out and do this business. Like that's kind of the ideal personality mix, I think there. But and then just making sure it's a good match. And I see it as a potentially a significant timeline reducer, if you will, accelerator.
100%.
So what you did in the way of and you've talked about it a few different times now, like all the things you did to network. It was like two-pronged attack for you. It sounds like self-education and networking, right? Boom, boom. Like those two focuses to kind of launch yourself into this space. Yeah.
Correct. Yeah. You could throw mentors in there as well, but yeah, networking, mentors, books, podcasts, all those things. Yeah, definitely partake in all those.
What are another kind of question along those lines? Do you go to any of the big national conferences?
Yeah, I do. Yeah. A couple times a year, I'll go to some of those. Yeah. Absolutely.
Cool.
The Best Ever conference is really good. I like going to that one.
Yeah.
Jake and Gino can be good. Michael Blanc conference can be good. So yeah,
that's so funny. Those are the first three I always mention. Like, in fact, I have and listeners, you can reach out to me for this. I don't mention it a whole lot, but I have a resource list, if you will, of kind of everything Justin just went through, all the books, podcasts, et cetera, platforms that I think are well worth your attention and time. And I put 3 conferences on that list, and they were those 3 that you just mentioned in that order: Best Ever, Jake and Gino, and Dealmaker Live with Michael Blanc. So, good stuff, man. Awesome. Justin, so like talk for a second about like what the opportunity is, for a listener to maybe interact with you, learn from you, potentially work with you at some level, or, invest, that sort of thing. What does a listener want to do there?
Yeah, you can find me on LinkedIn, just my name, Justin Goodin. If you're interested in learning more about, working with us and checking out our future opportunities, you can go to nextlevelequity.com. And also, just with my background and expertise in, multifamily underwriting and analysis, I actually created a proprietary multifamily underwriting model. So I have some models on a second site and a lot of, free educational content. And if you're interested in, checking out those resources, you can go to nextlevelfinancialmodeling.com.
Mm-hmm. Yeah. Yep. And again, on Next Level Equity right now, great resources for especially passive investing, limited partners, but just great general market knowledge, blog posts, a downloadable ebook, which will summarize a lot of what we talked about today about why apartments and multifamily are such a great opportunity, great asset class to be in. So, Justin, this has been great, man. Really appreciate everything that you brought in your story and all the lessons you learned, and super excited to be, in markets that are as close as we are and kind of aligned interest wise as we are. But also excited that, for listeners to connect with you and learn from you as well. So thanks a ton, man. Wish you all the best.
Thank you. Yeah. Thanks for having me, Tate.
Yeah. And we'll be obviously in touch with each other and always let Greenlight here know what we can do for you there in Indianapolis. So, and then listeners, of course, appreciate you guys. And hopefully you got a ton out of this episode with Justin Goodin. Again, I really encourage you to connect with him, especially on social media. At the very, very least, he just drops a ton of value, lots of compelling questions and conversations. So with that, guys, thank you, everybody. And we'll see you on the next episode. Take care, everybody.
This has been The Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of The Apartment Gurus.